Mitie Group shares jumped 39% in a single morning, hitting a record high of 213.6p after the company agreed to a 3.1 billion cash takeover by rival outsourcer OCS Group at up to 221.6p a share. The paradox sits one line below the headline. Mitie announced this takeover on the same day it reported record revenue, record operating profit, record contract wins, and a record £32.5 billion bidding pipeline. First quarter revenue rose 10% to £1.41 billion, more than triple the broader market's growth rate, with contract wins and renewals of over 30%.
The clearest evidence of the contradiction is procedural, not rhetorical. Mitie immediately suspended its £100 million share buyback program the moment the takeover was announced, a program under which it had already repurchased 49 million shares for £81 million since October, at prices far below the 221.6p offer. A board that was actively buying its own stock as undervalued days earlier is now recommending shareholders sell that same stock to someone else. The buyer's side shows a different kind of positioning. OCS has already secured a commitment covering a further 9.9% stake held through swaps by hedge fund Oasis Management, on top of irrevocable undertakings from Mitie directors covering just 1.2% of the share capital. In other words, the largest single vote already locked in behind the deal belongs not to management, but to an outside fund that structured its exposure through derivatives ahead of the wider shareholder vote. Panmure Liberum's own note to investors captured the asymmetry directly, telling clients it seems likely this bid proceeds on these terms, with only a remote risk of a counter from an interloper. That is an analyst effectively conceding the board's preferred outcome will happen, even while the same analyst community is on record calling the pre-bid valuation too cheap. The disagreement is not between bulls and bears on Mitie's business. It is between the price the market was willing to pay yesterday and the price a private buyer is paying today, with almost no one betting a third party steps in to bridge that gap. Chair Chris Rogers framed the board's own logic as choosing the certainty of cash over the deferred upside the buyback and the record pipeline both implied was coming. That is the actual mechanism behind today's decision pressure. Not that Mitie is being rescued, but that its board traded a compounding growth story for a locked-in premium and priced that trade-off at a level high enough that almost no analyst expects it to be topped. Mitie's exit is not an isolated transaction. Bloomberg data puts the cumulative value of takeover deals targeting London-listed companies at more than $60 billion this year, with the UK market losing more than $2 billion in market capitalization every week. Not to a crash, but to companies being bought and delisted entirely. The Mitie deal landed just days after ABB's $5.5 billion takeover of industrial group Rotork, and alongside an ongoing pursuit of warehouse landlord Segro by US group Prologis. The scale gap is the point. Barely $685 million has been raised through London IPOs this year, less than a third of what the market loses to takeovers in a single average week. Analysts describe the pattern as foreign and private equity buyers treating UK-listed companies as structurally cheap relative to US and European peers. The same undervaluation logic A.J. Bell applied specifically to Mitie now shows up market-wide. That pattern is where the anchor to this specific stock becomes concrete rather than abstract. Among the buildings Mitie's own workforce cleans and maintains daily are the Houses of Parliament and the Royal Opera House, alongside long-standing contracts with the NHS and Network Rail covering hundreds of stations. A company whose logo most viewers have never consciously registered turns out to already sit inside daily public life. And it is that company, not an obscure midcap, disappearing from the public market in this wave. So the same undervaluation that made Mitie a buyback candidate weeks ago is what makes it a takeover target today. And the wider pattern shows this is not a one-off mispricing correcting itself. It is a repeatable trade that keeps shrinking the pool of London-listed companies available to domestic investors. That repeatability is what turns Mitie's board decision from a single company's story into a market structure question the next chapter has to resolve into something checkable.
The deal is not yet closed. Completion is targeted for the first quarter of 2027 and still requires shareholder approval through a Scottish court-sanctioned scheme of arrangement, plus Competition and Markets Authority clearance and national security approval, relevant given Mitie's government, defense, and immigration center contracts. Each of those is a discrete checkpoint between today's 39% pop and the cash actually landing in shareholder accounts. For a holder deciding whether to sell into today's rally or wait for completion, the gap between Mitie's current 213.6p trading price and the full 221.6p offer value is the number that matters. That spread is the market's own estimate of deal completion risk, and it narrows or widens as CMA and National Security Review progress. A holder who exits today locks in most of the premium immediately, without carrying regulatory risk into 2027. A holder who waits is betting the remaining spread closes cleanly. For a watcher considering entry rather than holding, the trade only becomes attractive under one specific condition: a competing bidder emerging to top 221.6p, the scenario Panmure Liberum called a remote risk but did not rule out entirely. Absent that, buying in above the current price to capture a narrow completion spread is a trap. Regulatory delay, a national security objection given the government contract exposure, or a shareholder vote complication would each send the price back toward pre-bid levels near 150p, not up. The single variable that discriminates this outcome before the quarterly timeline plays out is the Competition and Markets Authority's Phase 1 decision and the scheduled shareholder vote. Both print well before the targeted Q1 2027 completion and will show directly whether the deal is progressing cleanly or drawing the kind of scrutiny that reopens the valuation question the board just closed. That is the checkpoint to watch before acting, not the headline premium already on the screen.